So in this episode, we're going to discuss whether we should fully pay up our house, or rather what are the opportunity costs involved when we fully pay up our home loans. Now, fully paying up home loans is definitely a burden off the shoulder because you don't have to worry about monthly installments. If one day you were to decide to go self-employment, you don't have to worry about paying that monthly mortgage anymore. Or even for legacy, if one day we were to pass on, we know for sure that our kids have a shelter, our spouse have a shelter. They don't have to worry about forking out the monthly mortgage. But the question is, when you pay up fully your housing loan, is there opportunity cost involved? And if you were to put a price tag to this opportunity cost, what would it look like? Okay, so recently we helped one of our buyers who were in this exact situation when he has the ability to pay up fully the housing loan, and he questioned whether other than fully paying up the housing loan, are there other options? What are those? And if I were to pay up fully, am I going to miss out on certain other options that I'm not even aware of? Okay, so today we're going to just share with you what is that opportunity cost involved, and is there a price tag to it? So the question that we just shared with the buyer is, okay, all of us, we're going to pass on one day. And if you were to pass on tomorrow, would you want to leave behind 5 mil to your son, or do you want to leave behind 6.7 mil? So the buyer was asking, the owner was asking, what do you mean? Okay, so maybe let me just share with you an illustration. So this is the current situation. He has a house, 4.2 mil in valuation. He has about an outstanding loan with the bank of about 1.7 mil at the current moment. So in the bank itself, he has a savings of amounting up to about 2.5 mil. Okay, so he's asking whether he should take the 2.5 mil to fully pay up 1.7 mil. So yes, he can definitely do that. Okay, so say for example, he uses this amount to pay fully the 1.7 mil, which means that his bank account will be left with about 800k. Okay, so let's say one day he were to pass on. Okay, what would his kids or what would he leave behind his kids? Now he will first and foremost have a fully paid up house. Okay, 4.2 mil, and in his bank account he will have 800k. Okay, so in totality, if he were to pass on today, after he has fully paid up his house, it will bring us to an amount of 5 mil. This 5 mil will be paid, to the children, to the spouse, etc. But what happens if he doesn't fully pay up the loan? Okay, how would it look like? So let's say, for example, he does not choose to pay up fully his housing loan. What will happen? So let's say tomorrow he were to pass on. First and foremost, the insurance will kick in. The insurance will cover the 1.7 mil, meaning to say that this portion here will be fully covered by the insurance. So his property of 4.2 mil will be fully paid up. Okay, and not just that, he also has a 2.5 mil that's still sitting inside the bank. So in totality, if he were to pass on tomorrow and he doesn't pay up fully his and he does not have a fully paid up property, what will he leave behind to his spouse and kids? Okay, so he will get the 4.2 mil, okay, as well as a 2.5 mil, and this will bring us to an amount of 6.7 mil that he will leave behind to the kids. And this is the power of leveraging on insurance. So this is one example on how leverage works, and if you know the power of leveraging, then you can actually make your money work harder for you. Right, I hope you found this useful, and I'll see you in the next episode.